Hello everybody, Alex here. Welcome to my Finance and Accounting Education channel. Today we are going to talk about the pandemic and the effects of the pandemic in the, let's say, in the savings and the debt of younger generations, namely the millennials or the Y generation and the Z generation, people under so between the ages of 18 and 41 years old. We have an article from CNBC. You will see it's a very interesting article, and what's making it interesting is that somehow for me, and after reading it several times, it's not clear what they mean exactly through savings. Or I think from the personal finance point of view, I need to make a lot of comments on this topic of savings. It probably was never a very good idea. How the savers are losers, let's say. It's always a saying that's going on around. And besides the fact that some concepts and some ideas from this article are not very clear, there are also a lot of events which are described in this statistic. In the statistics in the article, which somehow contradict other events which are happening in the society right now, and we will see exactly which ones and how. But before we jump right in, I'm going to ask you to subscribe to my channel, to hit the bell notification button, and you will never miss an update on my side. I do them quite regularly these days. You should expect new and hopefully interesting videos from me on Tuesdays, Thursdays and Sundays as well. That being said, so we have the article from CNBC from February the 12th of Saturday, February the 12th. The pandemic quickly eroded savings for Gen Z millennials, according to a study. Only about half of all Americans, 53%, say they now have more money in their emergency savings than what they owe in credit card debt, an unfortunate side effect of the pandemic. Now, just from the start, we have this video which I did previously, which says how to get rid of, so it's named How to Get Rid of Debt, which broadly states that debt and savings or investment should not really coexist unless there are some exceptions. The idea is that, and this is not very clear, when you say saving, you either think about money which is laying around in your current account or in some sort of bank deposit, or even in a physical form in your house, in your apartment, in some envelope, in some drawer or something like that. Now we have inflation is rising, above 5% in Europe, above 7.5% in the United States. I don't think it will stop very soon. That means that the money which you are holding in this physical form, or even the interest rates for your current account or for your bank deposit, are far lower than the inflation rate, and you are losing, and in the same time you have to pay increasing interest rate for your credit card, so for your credit card debt, which makes this, having both of them in the same time, absolutely, it makes no sense. In the same video I was telling that it probably makes sense to have some debt for investing, but it should not happen all the time, and only, I mean, it's risky, let's say it like this, because you can end up with a poor investment and with debt after doing that as well. It's especially bad for younger Americans, with a large chunk of millennials and Gen Zers saying the pandemic ate away at their savings. Now, it's also specific to United States, and it's not present here in Europe, or not in that form, and I'm going to try to somehow clarify, is the discredit score, which you have in the United States, and for the European people easier to understand, it works like the bonus malus system in the third party liability, in the mandatory insurance for vehicles. The people are coming of age, so they are adults at 18 years old, or yeah, something like that. I'm not talking about drinking age and so on and so forth. That's something else. And in Europe, let's say the insurance companies as well as the lenders in the United States, first of all, they most likely, I mean, I know that for sure, it's for the car accidents, and probably also for the defaults. The younger people tend to have more car accidents. Probably they also tend to default on their credit installments more than the older people. And also, what you don't have a history. So they don't know how you behave as a human being, as a citizen, if you are paying all your debt in full and on time and so on and so forth. So in basically in Europe, you start with paying the highest premiums, insurance premiums, when you are young, and then by not having any accidents, you get your this bonus malus system. You get improvements in time, and you pay less and less on your premium with the age, of course, and actually with the passing of time. And it's the same with the credit score system in the United States. Once you start having some debt and repaying it normally without any defaults and without any troubles, your credit score improves and so on and so forth. That's why, for example, in the United States, it's actually recommended to have a credit card and to buy something and to get some small amounts of debt in order to improve your credit score before. And I understand that the maximum is 800, and the higher you are and closer to 800, before you are doing probably let's say the largest, you are taking the largest debt you will ever take, and for the longest period possible, which will be your first mortgage for your first house or apartment. And if you have a higher credit score, you will get a better interest rate on your mortgage, which is only natural. In Europe, for credits, most of the countries might have some centralized register in which the banks are feeding data about the people that have defaulted on their credits and so on and so forth. And it might be that once you try doing some refinancing or taking a new loan and so on and so forth, you will appear in this register, and you probably won't get a loan, or from more conservative banks, or if you will get one, you will get from a financial institution maybe with a higher interest rate and so on and so forth. So there is something similar also in Europe, but not some specific credit score which is attached to you like in the United States. Actually, it's working in the other way around. You are presumed to be in Europe with a credit score. You are presumed to be a good customer unless there is any information that you are a bad one. In the United States, just as I have said, it works more like this insurance bonus malus system in the Europe. Also, very important about credit card, you can use it in two ways. Sometimes you need a credit card, even if you don't need debt or the money. It's okay, it's always good to have some money which are within your reach very fast if you get into trouble. So even if it's a credit card system, of course there will be costs, some management fees or whatever you will pay for it, but sometimes you just need it for some websites, or at least in the past they accepted only credit cards for vehicles renting, because they need to block a specific amount from your credit card in case something bad happens, an accident with the car, and you just couldn't live without a credit card even if you don't really specifically need the debt. And that would be the guys which are using the credit card as a non-revolving product, meaning that they pay the debt immediately after 1 month and they don't pay any interest rate, so the debt gets paid 100%. That's called the free rider, free riding the credit card. Or you can have it as a revolving product and just paying that minimum 5%, or how much is it of the debt that you have, paying 5% per month and with associated interest rates and so on and so forth. During the pandemic, millennials who range in age from 26 to 31 and members of Gen Z who are between the ages of 18 and 25 were among those whose savings took the biggest hit, according to a new Bankrate survey released Wednesday that surveyed more than 1,000 US adults in January 2022. Millennials were also more likely than other age groups to owe more in credit card debt than what's in their savings. Somehow, because I told you that besides the fact that it's not clear what they mean with saving, if it's this net worth approach, which I like more, basically having regularly once per month or once per quarter or once per year. Let's say once per month will be overdoing it, once per year is not often enough, maybe once per quarter it's worth doing it. Just listing everything that you have, being the latest value of your house or apartment, the actual value of your car, if you have bonds, if you have shares, if you have the surrender value of your insurance policy, the guaranteed amount of your pension fund, everything that you own, even cash, if you have, say, so-called savings, if you have a bank deposit, bank accounts, and so on and so forth, list them on one side with the latest available values for them, and on the other side list your debt, if you have mortgages, if you have leasing, if you have any other type of consumer credit, if you have credit cards, and so on and so forth, and deduct this from the assets side, and you come up with a number which hopefully is increasing from period to period, and it's increasing more than the inflation rate. That would be the idea. It will help you track down your net wealth and how is that developing with time, and hopefully it's increasing, just as I have said. And what's interesting in this article is because they are saying the younger generations took a hit during the pandemic. First of all, it's contradicting another phenomenon which is present in the society, and especially in the United States and in the Great Britain, a little bit less, but still present in the continental Europe, not that much, is this great resignation, because people that have less and less savings and more debt don't tend to resign their jobs, to start freelancing, to start independent work, to start their own jobs, not to work anymore, and so on and so forth. So somehow this is contradicting it. Unless I was thinking that, and I haven't seen any statistics, if the great resignation participants are not the ones in the Gen X and in the actually in baby boomers generations, people that are above 50, let's say, sometimes approaching their pension age, and that decide to retire earlier, and which will totally make sense because probably they don't have the same problems with the development of their savings and credit card debt. Near half of the Gen Z respondents, 46%, say their emergency saving is less in 2022 than it was at the start of the pandemic, while 43% of millennials said the same thing about their savings. The results were even worse for younger millennials, those between the ages of 26 and 32, with 54% of them saying their emergency savings declined during the pandemic. By comparison, about 37% of Gen Xers said their savings declined during the pandemic, as well as only 27% of baby boomers. So you see the Gen Xers and the baby boomers are somehow less affected. It all starts by building and I'm linking right now a video, how to do it by building your monthly budget in Excel and knowing what are your regular expenses, how much you are making, and if you can save and also invest afterwards. Remember, investments have different degrees of liquidity. If you are thinking in terms of emergency funds, you can turn into cash very fast if you have investment funds, either exchange traded funds or mutual funds. If you have bonds, if you have stocks, you can immediately turn this into, so in a matter of one day, the most, you can turn them into cash. However, there are some investments which are harder to turn into cash. Think about paying a down payment for a house or an apartment. You need to refinance either to refinance your house, or you need to somehow sell it in order to get the money back. Also, be careful with the pension funds and with the insurances, that sometimes it might be more complicated to get the money back, or you might lose some benefits or even lose a chunk of the money that you have already contributed if you withdraw from the program. So be careful with this, but still holding the money in cash in your house or in the bank, in the current bank account or in a bank deposit, are probably the worst choices that you can make about your money. That's a byproduct of the income disruptions that were disproportionately borne by younger workers during the pandemic, particularly millennials. Greg McBride, chief financial analyst at Bankrate.com, tells CNBC Make It. In fact, the Economic Policy Institute found in 2020 that Gen Z was the generation most likely to see its members underemployed or unemployed on account of the COVID pandemic, which is only normal if you think the younger people are the last ones to join an organization and the less skilled and the less experienced, and they will always be targeted if the company in itself or the sector or the entire economies are getting in trouble, they will be the first victims of this. The Pew Research Center also found that Americans between the ages of 18 and 29, which covers both Gen Z and younger millennials, were among the most likely to lose a job during the pandemic, and they were the most likely group to be forced to take a pay cut. Not surprisingly for millennials, the decrease in their savings also coincided with an uptick in their credit card debt. According to Bankrate, 32% of millennials say that they now have in savings is less. What they now have in savings is less than what they owe in credit card debt. This is another, besides the Great Resignation, another phenomena which was present in the last 2 years and which is somehow contradicting this, unless it's fueled by the other groups, namely by the Generation X and by the baby boomers, which is hard to believe, is the inflation in all the asset classes. We knew that this helicopter money or relief checks in the United States have somehow fueled. Okay, on one hand they have fueled the luxury industry, so the luxury goods industry. But on the other hand, it led to inflation that's why we had such good returns in the S&P 500 and on stock exchanges. It led the inflation in the shares, so in the stocks, also in the cryptocurrencies. That's why the cryptocurrencies developed that much, and the NFTs and so on and so forth. I wouldn't expect baby boomers to be very much investing in cryptocurrencies and NFTs, but somehow these events are somehow contradicting themselves. I thought that the people had more money. It seems that not the younger ones, at least. However, Gen Z and Gen X tend to be doing better than millennials in that regard. The Bankrate survey finds with only 23% of Gen Zers and 24% of Gen X reporting their debt exceeds savings. Just starting out or coming of age during a financial crisis really cements an aversion toward debt and a greater prioritization of emergency. McBride says the pandemic may well prove to have this effect on Gen Zers. Before the pandemic, millennials actually tended to save more and avoid debt better than older generations because they were coming of age around the time of the dot-com bust and 2008 financial crisis. So the idea is that from crisis to crisis, which the negative effects in our lives happen somehow cyclical, but there are enough years in between them to forget what happened last time. Somehow we tend to forget. For example, dot-com burst 2000, 2002, 2008, 2010 financial crisis. If you are thinking between 2010 and 2009, 9 years to forget about everything and to launch yourself into more debt, into exotic traveling, into buying things that you don't need and so on and so forth, and you forget the bad events. The idea is that you should somehow try to behave responsible no matter what the kind of times you have, and you should try to save and most importantly also to invest during the good times, and then the bad times won't be that bad for you. But periods of income disruption or outright unemployment can quickly erode what savings have been built up and the resulting credit card debt that didn't previously exist, McBride says. On the whole, Bankrate found that the percentage of Americans who had more money saved than what they owe in credit card debt has declined slightly, down to 53% in January 2022 from 54% a year earlier. However, that number is actually higher than it was before the pandemic, when 44% of people in 2019 said that their savings outweighed their credit card debt. So you see, actually on a general population, the people saved more money or more people saved money during the pandemic. Yeah, so that means it's the Gen X and the baby boomers are responsible for it. For somehow saving more, while the younger generations have lost during the pandemic. As a country, though, a lot of Americans still don't have any emergency savings. If you are following any of these personal finance people that try to teach you about personal finance, they will say that you need to have this emergency savings that should cover at least 6 months of unemployment, so 6 months of monthly expenses. It's very bad. If you are living from paycheck to paycheck, if something happens, and definitely at some point something will happen, being it unemployment, caused by something which has happened in your company, which is specific only to you, or a sector problem, or bad things will happen cyclically and regularly, and you need to be prepared. Yeah, roughly 1 in 7 households have no credit card debt. The problem with having no credit card debt is maybe that they don't have any debt, or they didn't have any debt, and they have a very bad credit score, the thing which we were talking about before. And that means that if they get into trouble, they will get very high interest rates for debt. But also don't have any emergency savings, which is a precarious situation in its own right, because those households are more likely to have their finances disrupted by a large unexpected expense. McBride adds, Bankrate recommends taking a look at your budget and figuring out where you can afford to set aside small amounts of money in order to start building your emergency savings fund for a rainy day. If you remember in the video and in the presentation about how to get rid of debt, I was telling you that from my point of view, debt, and I used a clear color coding here, it's something which is in green, something which is in yellow. So green would be okay, yellow is not that certain, and red should be avoided at any cost possible. So green would be starting your own small business, although it carries risk. It's worth getting into debt for your small business, because the idea is that you are using the debt to invest and to gain more money later. So it totally makes sense to do it like this. Then education, and especially I've seen an article that the engineering degrees are really paying off in the United States, and if you want to acquire an engineering degree, it's okay to go into education. However, I'm linking right now a video with 21 money rules, in which a Harvard professor, Kotlikov, is saying that actually it's not really worth getting into debt for education. I mean, it's debatable, let's say. So then real estate, from my point of view, real estate is really debatable, because, and I mean physical real estate like a house or apartment, not investing in real estate investment trust, that's something else. Real estate is a good idea if you do it early in your life. If you start at 20-25 years old, you then pay your mortgage for 25-30 years old. When you are 50-55, you are done with the mortgage, and you start reaping the benefits, meaning that you will no longer pay mortgage rates, and you also you will need not to pay the rent that you're potentially paying, and that will be your benefit from the investment. If you are doing it later, just as in my case, I'm 40 years old, plus 30, 70, 75. When I'm done with the mortgage, I'm almost dead, so there are absolutely no benefits. There is also a more complex discussion if it's worth investing for the children that they will receive your apartment or house after you are dead, and somehow if that's really an investment. Then you have this purpose debt leverage investing. For example, I went into debt in March 2020 to buy shares, because that was the moment when I knew that the shares, it was clear from all the charts that the shares hit a certain button, and it was a good idea to go into debt then. And that was one of the, I think actually the only moment when I switched my credit card from a free riding one to a revolving one, in order to, for a few months till I managed to cover all the debt. And you see, it was done with the purpose. It's risky. There are actually people that say don't go into debt in order to invest. Yeah, in general, it's not a good idea, but it depends. Yeah, let's just say that if you are talking about block and how the very rich people are financing themselves without selling their shares in the companies that they own, and just taking credits against these shares and buying whatever they want to buy, property, yachts, and so on and so forth. So you see, the discussion is more complex here. And then there are the emergencies. Actually, this article from CNBC we just talked about is about emergency. Yeah, so the pandemic period, losing your job is an emergency. And completely in red is the stuff that you don't really need. Electronics, or very expensive electronics and home appliances, expensive designer clothes, exotic traveling, house renovation, lavish gifts, any sort of bling jewelry, and so on and so forth. You really should not. If you want to think about it like this, if you want to buy a handbag which is worth $10,000 or euros, or as a lady or as a man if you want to buy some sort of electronic device which is also worth $2,000. If you cannot save for a certain period, a few months, 1 year or whatever, in order to acquire those, what makes you think that you deserve to get those based on your credit? Because you probably will never be able, or it will be very, very hard for you to repay that debt, yeah, if you cannot save for that. When are you might be sure that you somehow deserve those rewards, let's say. Very simple. Let's say that you are getting your monthly paychecks, and or you have multiple income streams and so on and so forth. Everything is paid, and at some point you discover in your bank account that you have laying around $5,000 or euros and so on and so forth. And you, although personally I encourage you to save that amount and to invest it further to produce even more money, then when you somehow your current living style produced without you targeting for it, produced you a saving, or even if you are targeting for it, so you are doing that saving on a purpose, then you can afford to buy such a, yeah, from $5,000 you can buy a bag of $2,000. It's absolutely no problem. But when you are living from paycheck to paycheck, just using your credit card and having this sentiment and this feeling that you can actually afford that item because you have this line of credit, it's very, very bad on a longer term. So that would be it for today. I hope you liked the video. If you liked it, don't forget to hit the like button, of course, to comment in the comment section if you have something to add, to share it with somebody that might be interested about the impact that the pandemic had in both in the savings and in the debt. So in the credit card debt of the younger generations in the past 2 years. Below the and most importantly, do not forget to subscribe to my channel, to hit the bell notification button, and you will never miss an update on my site. I do them quite regularly these days. You should expect new and hopefully interesting videos from me on Tuesdays, Thursdays and Sundays. Also below this video we have a link. You can create an eToro account and trade their CFDs, which are similar to shares. They are actually mirroring shares from real life, and you can trade there without a commission or a fee, which is always a saving. No matter how often you are trading, once per month or once per year is always a saving, not paying any commission or fee. Also below that link you have an Amazon wishlist with hardware and software items which can help me improve the quality of my videos. That's being beneficial also for you because you'll get better videos from me. But let's just honestly say that from financial perspective that is the most inconvenient for you, and this is a channel of financial education. The easiest way through which you can support me is to subscribe to my channel, to hit the bell notification button, and of course to continue to watch my videos. My name is Alex Petrescu. This is my finance and accounting education channel here on YouTube. I thank you for your time and your patience today, and I look forward to presenting to you with the next opportunity. Goodbye.